We're diving into one of the most influential investment books ever written, A Random Walk Down Wall Street.
In this deep dive, we'll explore the key ideas from Chapter 5. Now, if you've ever paid even a little attention to the financial markets, it's clear Wall Street truly is the biggest game in town. We're talking, hundreds of billions, even trillions of dollars changing hands daily. Stocks, futures, options.
Yeah.
It's huge. And where the stakes are this high, well, the rewards for those at the top can be absolutely immense. A fresh MBA from a top school, they might pull in a couple $100,000 a year. But the top money managers, often making millions, sometimes hundreds of millions.
The compensation is certainly staggering, isn't it? What's fascinating, though, is that despite these huge earnings for professionals, there's this strong academic viewpoint. It often questions how much true value they actually add. This perspective often points towards the efficient market hypothesis.
Right, the idea that everything's already priced in.
Exactly. Simply put, it suggests all available information gets reflected in stock prices almost instantly. So, you might do just as well, maybe even better, just holding a broad market index fund.
So if the market might just price everything efficiently on its own almost instantly, why do investors still put so much effort into trying to predict stock prices? This intense quest, to time buys and sells, it's led to an incredible variety of forecasting methods.
Oh, definitely. Some are, truly.
Yeah.
Well, out there, you hear about people looking at sunspots or moon phases for market signals.
Really? Sunspots?
Yeah, strange stuff. But most investors typically lean into one of two main approaches: technical analysis or fundamental analysis.
Okay.
And those two approaches, they fundamentally tie back to different theories of how stocks actually get their value. Technical analysis, for instance, it really resonates with the castle in the air theory.
Tassel in the air, meaning it's about what others think it's worth.
Precisely. Value is primarily about what others are willing to pay. It's about the psychology of the crowd. Fundamental analysis, on the other hand, that's firmly rooted in the firm foundation theory.
Firm foundation, so finding the real worth.
Exactly. Aiming to discover a stock's intrinsic underlying value.
Okay, let's unpack the first one then.
Yeah.
The world of technical analysis, the chartists. What exactly are they trying to do?
Right. So technical analysis is essentially the art, or maybe science, of interpreting stock charts. These practitioners, they meticulously study past price movements and trading volumes. They're looking for clues, patterns, anything really that can hint at where prices are headed next.
Okay.
Their core belief is that only a small percentage of the market operates logically. The vast majority, they argue, is driven purely by psychology.
Psychology. So it's a game then.
Very much so. It's seen as a game of anticipating what other players will do, focusing on the market's mood, not necessarily the company's, actual business.
So if I'm a chartist, I'm basically ignoring the company's financials, its balance sheet, and just focusing on the chart. That sounds incredibly speculative.
It can seem that way. How do they justify it? Well, their core belief is that the market's collective wisdom, or maybe its collective emotion, is already baked into the price.
Baked in.
Yeah. They'd argue that focusing on external news, like earnings reports or whatever, is just a distraction. They operate on two main principles. First, they believe that all relevant company information, earnings, dividends, future performance, you name it, is already reflected in past stock prices and trading volumes.
All of it.
That's the claim. They see fundamental data as either irrelevant or, like I said, already priced in. There's a classic anecdote about an early chartist, John McGee. Apparently, he boarded up his office windows to avoid outside distractions.
No way. Just him and the charts.
Exactly.
Yeah.
He believed looking at anything else would just mess with his analysis. Pure focus on the price action.
Wow, that's dedication. Okay, and their second principle?
That stock prices move in persistent trends. They believe this strongly. They construct these charts, marking a vertical line for each day, showing the high, the low, and a little tick for the closing price. And below that, usually a vertical line for trading volume.
Right.
As these daily lines accumulate, they start to form patterns. Chartists see these patterns like an X-ray for a surgeon, revealing the underlying market dynamics, they'd say.
Okay, so once they've got these charts, these patterns, what are the specific signals they're hunting for? What tells them buy or sell?
Well, they're looking for several things. First, those persistent trends we mentioned, like a clear uptrend. You can often connect the low points to form an upward trending channel. The core belief is that trends, once established, tend to continue.
Okay, inertia.
Kind of, yeah. But then you also have resistance levels. These are price points where a stock seems to struggle to break higher, like it hits a ceiling.
Right.
And then there's the really famous one, the head and shoulders top formation.
Right.
That's seen as a clear sell
Well,
signal.
shoulders, like the shampoo.
Brief chuckle sound, implied, not written, sort of. The price makes a peak, a shoulder, then a higher peak, the head, then another lower peak, the second shoulder. Once the price falls below the neckline, that's a line connecting the lows between the head and shoulders, it's considered a definitive sign to sell.
A broken neckline means get out.
That's the idea. Though, of course, sometimes the market throws a curveball, a bearish signal might fail, and the price goes up instead. They call it a bear trap, an exception, you know.
It sounds like a very short-term game then. They're not looking to buy and hold for years, are they?
Not at all. Chartists are definitely short-term traders,
Yeah.
very much in the moment. They buy when the charts look favorable, and they sell, often very quickly, when ominous signs appear. It's all about quick in-and-out trades, not long-term commitment to a company.
Quick flips based on patterns.
Exactly. And actually, it's interesting, their vocabulary. Terms like double bottoms, breakouts, buying climaxes. Some psychiatrists have even noted that some of this terminology carries, well, sexually suggestive undertones.
Really, buying climaxes. That's descriptive. Suggests a lot of emotion, maybe.
Perhaps. It hints at the almost visceral, emotional investment in these quick moves, where the timing feels like everything, like catching the perfect wave.
Okay, so if it seems so driven by maybe emotion or at least market psychology and kind of abstract, why do chartists believe this method actually works consistently, especially when it's supposed to be a rational market?
Well, they'd argue it taps into genuine market dynamics, things that are real. Take the herd instinct, for example. When a stock starts moving up, it's just human nature for others to jump on board, right? Chasing that momentum.
FOMO, fear of missing out.
Exactly. Chartists argue they're simply observing and profiting from that undeniable human tendency. It can become a self-fulfilling prophecy. The rising price itself generates more buying interest. Another idea is unequal access to information.
Ah, like insider trading.
Well, not necessarily illegal insider trading, but just how information spreads. When good news comes out, maybe company insiders know first and start buying, pushing the price up a bit. Then maybe their friends find out, then the professionals, and finally the general public gets the news. This gradual diffusion of information could create trends that chartists pick up on, like sniffing out where the smart money is moving before everyone else does. You know, think about cases like clone systems back in the day where some insiders allegedly benefited from non-public info. That kind of gradual spread could show up as a trend on a chart.
Okay, that makes some sense. And what about investor psychology regarding past prices? Does that play a role?
They think so, yeah. Chartists point to how investors remember their past buying prices. Say you bought a stock at $50 and it drops to $40. If it rallies back up to $50, a lot of investors might be really eager to sell, just to break even and get out.
Get their money back. Relief selling.
Exactly. So that makes $50 a potential resistance area or ceiling. Similarly, maybe a stock was at $40, ran up to $60, then pulls back to $40. Investors who missed buying it at $40 the first time might see this as their second chance and jump in. That makes $40 a support level, like a floor. The charts, they argue, simply reflect these predictable psychological responses.
Those are interesting rationales. It paints a picture of the market driven by memory and emotion. But what are the main arguments against relying purely on technical analysis?
Well, the biggest criticism is probably that technical signals often lag. They're based on past data. By the time a trend or a pattern becomes really clear and obvious on a chart, the significant price move might have already happened.
So you're always reacting, not predicting.
In a way, yeah. Chartists can kind of miss the boat because they're acting on what has occurred, not necessarily what's about to occur. The signal confirms the move after it's underway.
And what about the idea that if everyone uses the same signal, it stops working?
That's another big one. It can be self-defeating. If a particular technical trick or pattern becomes widely known and everyone tries to act on it at the same time, well, its predictive value evaporates pretty quickly. Everyone rushes for the exit or the entrance simultaneously.
Makes sense. The edge disappears.
Right. And perhaps the most powerful argument against it, coming back to what we discussed earlier, is market efficiency itself. If the market really is highly efficient, then any truly valuable new piece of information, let's say a company's chief chemist discovers a revolutionary new process that could double earnings. the stock price wouldn't just gradually trend up for chartists to spot. It would adjust almost instantly to reflect that new reality.
Bang! Price jumps immediately.
Pretty much. As soon as the word gets out, institutional investors, smart money, they'd pile in or out so quickly.
Yeah.
The Malkiel book puts it nicely. The show is over before the chartist even gets on stage.
It certainly sounds like a tough way to consistently make money then. Yet technical analysis clearly still has a lot of followers, maybe even more now with technology.
Absolutely. Before computers, chartists were often seen as kind of eccentric, hunched-over graph paper, plotting manually. Today, with computers, they've morphed into technical analysts. It sounds more sophisticated, maybe. And they have instant access to hundreds of indicators, far beyond what anyone could chart by hand. Moving averages, RSI, MACD, Bollinger Bands, so much data.
A whole toolkit.
An entire digital playground of data. But the fundamental challenge, the criticism about lagging signals and efficiency, that still remains.
Okay, so if the chartists are trying to predict these market mood swings, often reacting after the fact, sounds like a real challenge, as you say, to consistently win this game. What's the alternative? The other main approach you mentioned. Let's switch gears to fundamental analysis. This feels like it should be much more, well, grounded, almost the opposite.
It really is, in philosophy at least. Fundamental analysis is all about determining a stock's intrinsic value, its firm foundation value. It's about figuring out what a stock is actually worth based on the company itself, separate from the market's often volatile optimism or pessimism.
So digging into the company's real business.
Exactly. There's a great anecdote from Fred Schwed Jr. about a broker selling a stock way above the current market price. When the client complained, the broker supposedly scoffed, "You people don't understand. When we select investments, we do it based on value, not price." That really captures the fundamentalist mindset. Value over fleeting price.
Okay, so while chartists see, 90% of the market as psychological,
Right.
fundamentalists would probably argue 90% is logical, or should be. What's the core job of a fundamental analyst then? What are they actually doing?
Their most important task, really the heart of it, is to estimate a company's future streams of earnings and dividends. That's what ultimately drives value. And this isn't just, pulling numbers out of thin air. It involves deep research.
Like what kind of research?
Oh, everything. Sales forecasts, operating costs, tax rates, debt levels, the company's capital structure. They'll often visit management teams, talk to suppliers, customers, competitors. Benjamin Graham, a huge influence in this field, called analysts prophets without divine inspiration. They have to rely on meticulous study, not magic. They usually start by analyzing the whole industry outlook, then dive deep into individual companies within that industry, hoping to uncover factors the market hasn't fully appreciated yet.
Trying to find that hidden value. And what are the key factors they focus on to determine this proper value?
There are generally 4 fundamental determinants they look at. The first, and arguably most important, is the expected growth rate.
Growth. Okay.
Yeah, future growth in earnings and dividends.
Right.
And most people really underestimate the sheer power of compound growth over time. Albert Einstein supposedly called compound interest the greatest mathematical discovery of all time, or maybe the 8th wonder of the world, something like that.
Strong words.
Because compound growth means your initial investment and the returns you earn on that investment both start earning further returns. It's this exponential engine of long-term wealth. Think about that story of Manhattan Island. If the $24 paid for it in 1626 had been invested at, say, 6% interest.
It would be worth billions today, right?
Over $100 billion,
Yeah.
easily. It illustrates the incredible power of long-term compounding.
And that reminds me of the rule of 72, that quick way to estimate doubling time.
Exactly. A great mental shortcut. Divide 72 by the annual interest rate to get the approximate number of years it takes for your money to double. So at 6%, it doubles in about 12 years. 726 is 8%. It's 9 years. It just underscores this exponential power. But, and this is a huge but for investors, sustained high growth is incredibly hard for companies to maintain.
Why is that?
Well, think about percentages. A small startup adding $1 million in sales might be 100% growth. That's amazing. But for a giant corporation like Apple or Microsoft, adding that same $1 million is, well, it's a rounding error. It's much harder to maintain a high percentage growth rate as the base gets bigger and bigger. Competition increases, markets mature. It's like population growth. You can't just extrapolate high rates forever. The book uses a funny example. If California kept growing faster than the U.S., eventually like 120% of Americans would live in California.
Chuckles implied. Clearly impossible.
Right. So the first rule for fundamentalists is, Rule 1, a higher expected growth rate for dividends and earnings justifies a higher price a rational investor should pay. And the corollary is, The longer that period of supernormal, above-average growth is expected to last, the higher the justifiable price.
Okay. And this expected growth, this often shows up in a stock's price to earnings ratio, the PE ratio, right?
Yeah.
So when we see a high PE, what's that really telling us?
It's essentially the market's shorthand forecast for future growth. A higher PE means investors are willing to pay more for each dollar of current earnings because they're betting on significantly higher earnings in the future. So the key insight for you, the listener, is this. Look at that PE ratio. If it's way higher than the company's historical average or its competitors, especially if the growth rate doesn't seem to justify it. Like the book mentions General Electric at one point having a PE of 20 when maybe 18 was average for its growth rate. You might be paying for excessive optimism. Overpaying for growth is a classic trap.
Got it. Price relative to expected growth. What's the second determinant?
The second one is the expected dividend payout ratio. How much of its earnings does the company pay out to shareholders as dividends? All else being equal, Rule 2 says, a higher proportion of earnings paid out as dividends generally makes a stock more valuable. Investors like getting that cash.
But wait, don't high-growth companies often reinvest their earnings instead of paying dividends?
Exactly. That's the nuance. A high payout ratio might actually signal low future growth prospects because the company doesn't see great reinvestment opportunities. And many fast-growing companies, especially in tech, prefer to retain earnings or use cash for share buybacks rather than paying dividends, aiming for higher future growth that way. But comparing two companies with similar growth outlooks, if one pays out a larger chunk of its earnings as dividends, fundamental theory says it should be valued a bit higher. Okay, makes sense. And risk must play a role too, I imagine. Absolutely. That's the third determinant, the degree of risk. Risk is inherent in investing, and it definitely impacts valuation. Investors are generally risk-averse. They prefer lower risk for the same expected return, which is why stable blue-chip companies often command higher PE ratios than more volatile ones. Now, measuring risk precisely is notoriously difficult, but one common way is to look at a stock's price volatility compared to the overall market.
Like beta.
Beta is one measure, yeah. Or just looking at historical swings. For example, Johnson & Johnson is known for its stability. If the market drops 20%, maybe J&J only drops 10%. A more volatile stock, say Salesforce.com, as the book mentions, might plunge 30% or more in that same market drop. So Rule 3 states, the lower a company's perceived stock risk, the higher the price a rational investor would be willing to pay, all else equal. The takeaway for you is to understand your own risk tolerance and look for companies whose risk profile aligns with what you're comfortable with, because risk directly impacts value.
Right. Stability is valuable. That brings us to the fourth determinant.
The fourth one is the level of market interest rates. This is crucial. The stock market doesn't exist in a vacuum. Investors always have alternatives, right? Like bonds, real estate, even just cash in the bank. If interest rates are really high, like they were in the early 1980s when you could get almost 15% on corporate bonds.
Wow, 15%.
Yeah. Capital naturally flows out of relatively riskier stocks and into safer bonds offering those high yields. That tends to drive stock prices down. Stocks essentially have to become discounted goods to compete.
Right.
Conversely, if interest rates are very low, like they have been for much the last decade or so, bonds look less attractive and stocks become relatively more appealing. This tends to push stock prices higher. So Rule 4 is lower market interest rates generally lead to higher stock prices. What this means for you is that the broader economic environment, especially what the central bank is doing with interest rates, can significantly influence the entire market's valuation level, not just individual stocks.
Okay, so growth, dividends, risk, and interest rates. These four rules sound like a pretty solid framework for figuring out a stock's value, but I suspect it's not quite that simple in practice. What are the big buts or caveats?
You're absolutely right. It sounds straightforward, but applying it is tricky. There are three really crucial caveats with fundamental analysis. Caveat number 1, expectations about the future cannot be proven in the present. This is huge. All that forecasting of future earnings and dividends, it's inherently uncertain, it's risky. Just think about the extreme optimism during the dot-com bubble versus the profound pessimism during the 2008 financial crisis. The same companies might be viewed completely differently depending on the prevailing mood.
So sentiment still creeps in even when you're trying to be objective.
It inevitably does. Future prospects are filtered through the lens of current optimism or pessimism. And even the experts get it wrong all the time. As Samuel Goldwyn famously quipped, it's tough to make predictions, especially about the future. So the core lesson here is, any fundamental valuation is only as good as its underlying assumptions about an uncertain future. Garbage in, garbage out potential.
Okay, future uncertainty is unavoidable. What's the second caveat?
The second one is that it's impossible to obtain a precise value using uncertain information. This is where analysts can sometimes, well, fool themselves or others. You might do all your careful research, run your models, calculate a stock's fair value, and find it's actually lower than the current market price.
Meaning it's overpriced.
Right. But instead of concluding it's overpriced, an analyst under pressure, or maybe one who's already bullish, might be tempted to just tweak the assumptions a little bit. For example, maybe they assumed high growth for 10 years. What if they expand that high growth period to 11 years in the model?
Just nudge the inputs.
Exactly. And because of compounding, extending that growth period even slightly can significantly increase the calculated fair value, maybe enough to make the stock look attractive after all. You can basically manipulate the inputs to justify almost any valuation you want, within reason. The hard truth is, determining a stock's precise intrinsic value is impossible. There's a memorable quote in the book. The Almighty God does not know what the appropriate P/E ratio for a common stock should be.
Wow. That puts it bluntly. Even God doesn't know the right PE.
It highlights that even fundamental analysis has a significant subjective element. A truly precise objective value is probably an illusion.
Okay, that's a powerful statement about the subjectivity. And the third caveat.
The third one is that the market's valuation of growth itself changes over time. We know the market values growth, and higher growth rates generally lead to higher PE ratios. But the premium investors are willing to pay for that growth isn't constant. It fluctuates wildly.
Like fashions change.
Kinda, yeah. In the early 1960s, the go-go years, growth stocks commanded extremely high PE ratios. People paid huge premiums. Then, during the dot-com bubble in the late 90s, early 2000s, some tech stocks had PE ratios in the hundreds, astronomical levels. And we all know how that ended painful lessons for investors when those bubbles burst. So relying on historical PE ratios as some kind of fixed standard for what growth is worth can be really dangerous, because market sentiment shifts dramatically over time. Think tulip bulb mania.
Right, the market's appetite for growth isn't stable.
Exactly. The key takeaway for you, the investor, is that what the market is willing to pay a premium for today might not be what it values tomorrow. Chasing the hottest, most expensive growth story can lead to significant losses when sentiment shifts.
Okay, so it really sounds like neither pure technical analysis nor pure fundamental analysis is a guaranteed path to investment success. They both have pretty significant drawbacks. But do analysts or investors ever try to combine them, maybe get the best of both worlds?
Many do, yes. It's quite common to try and blend the approaches, leveraging the strengths of both while trying to mitigate their individual weaknesses. The book suggests 3 sensible rules for potentially combining them. Rule number 1. Only buy companies whose earnings growth is expected to exceed the market average for more than 5 consecutive years.
Focus on sustained, exceptional growth.
Exactly. Exceptional, long-term earnings growth is probably the single most important factor for major investment success over time. Because when a company's earnings grow rapidly and consistently, its stock price can benefit in 2 ways. First, obviously, from the higher earnings themselves. But second, the market might recognize this superior growth and award the stock a higher PE ratio. It gets re-rated upwards. This gives you a powerful double benefit.
Earnings go up and multiple the market pays for those earnings goes up too.
Precisely. The book gives an example where a stock might triple from $7.50 to $30, not just because earnings grew, but because its PE ratio also expanded significantly as the market appreciated its growth.
That sounds like the sweet spot. What's the second combined rule?
Rule number 2. Never pay more for a stock than its firm foundation value, even for great growth companies. Now, we just discussed how finding a precise intrinsic value is impossible, right?
Yeah, God doesn't know the PE.
Exactly. But you can still use benchmarks. A simple one is the overall market's PE ratio. Look for these potential long-term growth stocks, but try to buy them when their PE ratios are at, or maybe not much higher than, the average PE for the market as a whole. Peter Lynch, the legendary manager of the Magellan Fund, famously used a similar idea, looking at the PE ratio relative to the growth rate, the PEG ratio.
Keep the price reasonable, even for growth.
Right. If you buy a good growth stock at a reasonable PE, and that growth actually materializes, you stand to get that double benefit we talked about. But if you overpay wildly for growth that's already widely recognized and reflected in a super high PE, you risk a nasty double whammy if that growth slows down even a little bit.
Double whammy.
Yeah, both the earnings growth might disappoint and the market might slash that high PE ratio is willing to pay. The stock price can crater. The message is clear. Even for great companies, the price you pay matters immensely.
Okay, find long-term growth, but don't overpay. What's the third combined rule?
The third rule tries to incorporate the psychological element. Look for stocks whose growth story is one that investors are likely to build castles in the air upon, but make sure those castles rest on a firm foundation.
So solid fundamentals plus a story that captures the imagination.
Exactly. This rule acknowledges that the market isn't purely logical. Investors are emotional beings driven by greed, hope, fear, narrative. A company might have solid, maybe just average growth, but if it has a really compelling story, a new technology, a charismatic CEO, a product everyone's talking about it, can maintain a high PE ratio for a long time just because it generates good feelings and captures the public's imagination. People want to believe the story.
So you want that firm foundation of value, but also something that taps into market sentiment, potentially creating a positive feedback loop.
That's the idea. You want the solid fundamentals first, the firm foundation. But then, ideally, you find one with a narrative that allows other investors to build their psychological castles in the air on top of it. A technical analyst might then come in and use their charts here. They might look for an uptrend or other bullish signals to confirm that, yes, this investment story is actually gaining favor with the public, that the castle building is underway.
Interesting. So it's about combining the numbers with the narrative, the logic, with the psychology.
It's an attempt to do that, yes, but it also serves as a clear reminder, even with these combined rules, that consistently winning in this investing game is incredibly challenging. There's no magic formula.
Wow, what a deep dive into the real complexities of trying to value stocks and forecast where prices are going. It's really clear that both technical and fundamental analysis, while they're the main tools people use, they both have significant strengths, but also some really significant weaknesses.
Absolutely. And given those inherent difficulties, the challenge in precisely valuing companies, the unpredictable nature of market sentiment and psychology, it really raises a critical question for you, the listener. What does it truly mean to be a smart investor in a world where fundamental values seem elusive and market sentiment can just shift so dramatically, sometimes overnight?
That's a great provocative thought to leave everyone with. What does being smart even mean here? And for those of you wondering, how much faith should we put in all this analysis, technical or fundamental? Well, our next deep dives will actually dig into the real-world performance records. We'll look at how these approaches have actually fared over time to assess how much trust one should really place in professional investment advice. You won't want to miss that.
In this video, we'll explore the key ideas from Chapter 6.
And our mission today really is to tackle a question that, every investor bumps into eventually.
It should.
Do those patterns you see in past start prices actually tell you anything about the future? And maybe more importantly, should you bet your money on strategies that rely on them?
Okay.
We're going to, pull back the curtain a bit
Mm-hmm.
because knowing this stuff can genuinely save you from some pretty expensive mistakes, make you a smarter investor.
That sounds like a worthwhile goal. So let's dig in. When you talk about predicting the market, you pretty quickly land on something called technical analysis.
Right.
It's this whole idea that you can figure out where a stock's going by looking at where it's been.
Mm-hmm.
You hear those Wall Street sayings all the time, like, let your profits run, cut your losses short.
Don't fight the tape. Yeah.
Exactly. All comes from this technical mindset.
It's really seductive, isn't it? This promise that there are these repeatable patterns, these little signals hidden in the charts.
Yeah, secret codes.
Exactly. Signals that tell you just when to jump in, get in on the ground floor. It makes it sound like you've got this edge, like you can almost see the future just by reading a graph. But there's always been this skeptical view, hasn't there? Especially from academics. They kind of joke about technical analysts having, holes in their shoes and fog in their forecasts.
Yeah, that's the one.
I remember hearing this story, maybe apocryphal, about an analyst, shirt collar, frayed, And if someone asked why he wasn't rich from his own system.
Let me guess. I didn't believe my own charts.
You got it. And that old saying, never eat with chartists, bad for digestion. Because they always have some excuse for why things went wrong.
It leads to advice that's just so vague sometimes, it's almost funny. Like that joke prediction. If the market neither goes up nor down,
it will remain unchanged.
Yeah.
Not exactly helpful.
Not really. So when the academics actually crunch the numbers on all this pattern stuff, what do they find? Why are they so critical?
Well, it really boils down to two main things. First, when you add in the real costs like commissions, fees, taxes, technical trading just doesn't beat a simple buy and hold strategy. You might make some money, sure, but not more money than just holding on.
Which is the whole point, right?
Exactly. And second, maybe even worse for the technical folks, is how easy it is to test these ideas scientifically. And, well, frankly, how easy it is to show they don't work.
How so?
With computers today, academics can run simulations on decades of data in minutes. They can pinpoint exactly where these chart predictions just fall flat. It exposes the flaws pretty quickly.
Okay, so at the absolute core of technical analysis is this belief, right? That if a stock is going up, it'll keep going up, and if it's going down, it'll keep going down. The wallpaper principle, they call it.
Yeah, the idea that patterns just repeat, like wallpaper designs.
And that's what the research is really focused on.
Precisely. And the overwhelming verdict from, tons of studies is past price moves just aren't a reliable way to predict future ones. The market seems to have a very, very short memory, if any. You might see these little blips, these tiny trends pop up now and then.
But they don't last.
They're too short-lived, too unreliable. And by the time you factor in the cost of actually trading on them, any potential profit is usually gone. It turns out getting several up days or down days in a row happens about as often as getting several heads or tails when you flip a coin.
Which brings us right to this idea of the random walk. It feels wrong, doesn't it? Because we see patterns everywhere.
We're wired for it. It's human nature. Think about this. You can literally create a fake stock chart just by flipping a coin. Heads, it goes up half a buck. Tails, it goes down half a buck.
Okay.
If you do that hundreds of times and plot it out, you will see things that look like cycles, clear peaks and troughs. You'll even see those fancy patterns chartists love, like head and shoulders tops or triple bottoms.
Seriously, from random coin flips.
Yep. There's that great story about a researcher showing one of these random charts to a chartist friend. The friend got super excited, saw all sorts of buy signals.
Until he found out it was random.
Let's just say the friendship cooled off a bit after that.
Wow.
And that's the key insight, really. Now, is the market perfectly random? Maybe not quite. There might be these tiny, almost invisible lags as investors slowly react to new information.
So not perfectly random.
Some academics might talk about a non-random walk in very technical terms. But for you, the investor, the practical takeaway is the same. Even if tiny weak trends exist, they aren't consistently strong enough to make you money after costs. Plus, prices can overshoot, adding more risk.
It reminds me of testing a new drug. You don't just see if it helps. You compare it to a sugar pill, a placebo.
Exactly.
If both groups get better, the drug might not be doing much. So in investing, buy and hold is the placebo.
That's a great analogy. A technical strategy only proves itself if it makes you more money than just buying and holding after you subtract all those trading costs. So yeah, this whole idea that past prices don't help predict future prices because that information is already baked in. That's what's called the weak form of the efficient market hypothesis.
The weak form, okay.
Or as one academic bluntly put it, technical analysis is basically like astrology. Both look kind of scientific on the surface.
Ouch. That's pretty direct. But, okay, if the broad idea of chart patterns is shaky, what about specific named strategies? People swear by things like the filter system.
Right, the rule where you buy if a stock jumps, say, 10% from its low, and sell if it drops 10% from its high.
Yeah, something like that. Sounds disciplined.
It does, and it's related to common ideas like stop-loss orders. But again, the tests just don't bear it out. Researchers have tried all sorts of percentages, different time periods. Consistently, once you account for all the extra trading commissions this generates, these filter rules don't beat just buying and holding. You're often worse off because of the costs.
Okay, no filter system. What about the big ones, like the Dow theory, all that talk about resistance and support levels?
Same story, unfortunately. Tests show those buy and sell signals based on breaking through levels. They don't really predict anything meaningful about future prices. Following them usually leads to worse performance because of, you guessed it, high commissions.
Getting a theme here. How about relative strength? Buying the winners, selling the losers.
There was a big 25-year study on that one. The conclusion, no consistent benefit after you pay your transaction fees and taxes.
Price volume systems. A stock goes up on heavy trading volume. That's supposed to be bullish.
Oh, turns out those signals don't offer useful predictive info either. Just more trading, more costs eroding your returns.
And even the really complex patterns, head and shoulders, triple bottoms, all that stuff.
There was a massive computer study that scanned thousands of stock charts, looking specifically for 32 of the most popular intricate patterns.
Yeah, the result.
After accounting for transaction costs, those patterns showed zero relationship to how the stock performed afterwards. Zero.
It's just amazing how much we want to see patterns, isn't it? Even when things are random.
It's deeply human. That's why technical analysis is so appealing. Think about the hot hand in basketball.
Oh yeah, everyone believes in that. A player makes a few shots, they're on fire.
Right. But psychologists actually analyzed thousands and thousands of shots. And guess what?
Let me guess. It's not real.
It's not real. A player's chance of making the next shot is completely independent of whether they made the last few. Streaks happen in random sequences, just like in coin flips. We just remember the streaks and forget the misses. It's a memory bias. Same thing happens when we look at stock charts.
That's fascinating. Our brains trick us even with something physical like basketball. No wonder we do it with abstract stock prices. And speaking of things that don't work, there's some really out there theories too, right? Like the hemline indicator.
Ah, yes. Bull markets and bear knees. The idea that skirt lengths predict the market. Rising hemlines in the 20s bull market, falling hemlines in the 30s crash.
Did it ever work?
Not really, no. Maybe a couple of coincidences, but way more misses than hits, especially later on. And now, with fashion trends being all over the place, well, it's just a fun historical footnote. Definitely not investment advice.
Okay, scratch hemlines. What about the Super Bowl indicator? NFC win means market goes up. AFC win means market goes down. It's supposedly right surprisingly often.
Which is pure coincidence. It's a classic case of finding a correlation where there's no causation. Someone famously pointed out that butter production in Bangladesh correlated better with the S&P 500.
Okay, point taken. No Super Bowl trading. What about the odd lot theory? The idea that small amateur investors are always wrong.
Well, there's maybe a tiny bit of evidence that these odd lot traders do slightly worse than average, but trying to build a strategy around doing the opposite of what they do, it just doesn't generate consistent profits. Their activity isn't a useful signal.
Then, the dogs of the Dow. Buying the highest dividend yield stocks in the Dow Jones Index? That sounds more plausible.
It did have a good run. For a while, it actually beat the index quite nicely. But then it got really popular.
And that killed it.
Yep. Too many people started doing it, and the effect disappeared. It started lagging the market. Even its creator admitted it got too popular and stopped working. Shows how strategies can self-destruct.
And lastly, the January effect. Higher returns early in the year, especially for small stocks.
That one seems to have some statistical basis historically, but the problem for you as an individual investor is that trading small, less liquid stocks involves higher costs.
The costs again.
Right. And the effect isn't perfectly reliable every single year. So trying to actually capture that small potential gain usually costs you more than you make. It's interesting academically, but not really practical.
Okay, so the specific strategies seem to crumble under scrutiny too, which logically leads us to the gurus, the market forecasters. Someone must get it right consistently, right?
You'd think so, but history suggests not really.
Like Robert Prechter in his Elliott wave theory in the 80s. He made some huge correct calls early on.
He did. He predicted the big bull market, even called a target for the Dow pretty accurately. He looked like a genius for a while.
But then,
Well, after the 87 crash, which, to be fair, he did warn about, to some extent he turned extremely bearish. He predicted the Dow would crash below 400 in the early 90s.
which didn't happen.
Not even close. He completely missed the massive bull market of the 1990s. It just shows if you keep predicting doom, eventually you'll be right for a bit, just by chance. Same if you always predict sunshine.
And Elaine Garzarelli, she famously nailed the 1987 crash almost to the day.
Incredibly impressive call, very specific. She was everywhere, the prophet of Black Monday.
But after that,
She stayed out of the market, completely missing the huge rebound that followed. Her followers were understandably disappointed. Her excuse,
don't tell me.
I failed to believe my own charts. The classic line.
Unbelievable. And the Beardstown ladies, that heartwarming story of grandmas getting amazing returns.
Yeah, they sold millions of books based on that story. But sadly, it wasn't true. An audit later showed their claimed 23.9% annual return was just made up. Their actual returns were way below the market average.
Sobering stuff.
It really is. It just proves you can't rely on these market idols.
The takeaway seems pretty stark. Lots of predictions out there. Someone's bound to get lucky now and then. But finding consistent accuracy seems impossible. Like that proverb, he who looks back at the prophecies of market seers shall die of regret.
A very apt proverb.
So this is the big question then. If technical analysis is so thoroughly scientifically debunked, why is it still everywhere? Why do brokers still push it? Who is benefiting?
Well, now you're getting to the heart of it. The persistence of technical analysis isn't really about whether it works for investors.
It's about.
It's about the fact that technical analysis encourages trading. Lots of buying, lots of selling. And what does trading generate?
Commissions.
Exactly. Commissions are the absolute lifeblood for many brokerage firms. As the saying goes, technical analysis helps clients build yachts for their brokers.
That makes a cynical kind of sense. It persists because it's good business for the industry, not necessarily good results for the client.
That's a big part of the picture, yes.
Okay, but technical analysts push back, right? They don't just accept the random walk idea. What are their main arguments? I hear things like, the market isn't random.
Right, and that's based on a misunderstanding. Random walk doesn't mean stock prices move irrationally like they're completely nonsensical.
What does it mean then?
It means that new information that affects stock prices like earnings surprises or a sudden strike or a new invention arrives unpredictably, randomly. If it wasn't random, it wouldn't be news, would it?
Good point.
So the weak form just says you can't predict the next price step based on past price steps. Think of a drunk staggering across a field. His individual steps are unpredictable, random, even if he has a general direction he's trying to go.
Okay, that clarifies it. What about when they say, well, you haven't tested my special system?
And technically, they might be right. Academics haven't tested every single possible variation of every rule.
Well put.
But what the research strongly indicates is that even if you could find some tiny, fleeting pattern that offered a slight edge, the cost of trading on it, commissions and taxes, would almost certainly wipe out that edge.
Like trying to find a pattern in roulette at the casino.
Exactly. People convince themselves they see patterns, but the house edge always gets them in the end. Transaction costs are the market's house edge against active traders trying to exploit tiny patterns.
And that brings up another fascinating idea, this self-defeating prophecy aspect.
Yes, this is crucial. Let's imagine someone actually did discover a reliable technical rule that consistently made money. What would happen once it became known?
Everyone would start using it.
Right. And the moment everyone starts trading on the signal disappears. Think about that supposed year-end rally. If everyone knows prices tend to rise after Christmas.
They'll buy before Christmas to get ahead of it.
Exactly. Which makes prices rise before Christmas, eliminating the rally itself. Any easily discoverable, profitable rule in an efficient market tends to cancel itself out very quickly.
That's a powerful argument against finding some secret technical key.
It really is. It suggests that the search for such a key is likely futile.
So let's bring it all together. What's the bottom line for you, the listener, trying to invest sensibly?
The core message, loud and clear, is that studying past stock price charts and patterns isn't a useful way to predict the future.
Technical strategies might feel reassuring, maybe, but they don't really add value.
Exactly. They lack practical value once you factor in the real world. That's the essence of that weak form of the efficient market hypothesis. Past price data is already reflected and doesn't give you an edge.
And trying to jump in and out based on these signals, trying to time the market, is actually risky.
Incredibly risky. Get this. Over decades, something like 95% of the market's total gains often come from just a tiny handful of days. Maybe 90 days out of 7,500 trading days over 30 years.
Wow, 95% of the gains in just over 1% of the days.
Something like that. If you're trying to time the market, you run a huge risk of being on the sidelines during those few crucial days when the big gains happen. There's data showing if you missed just the best 5 trading days each year going back to 1900, your returns would be practically nothing.
So being out of the market for even a short time can be devastating.
It really can. Market timers inevitably risk missing the big upswings.
So the alternative, forget the complex charts and strategies.
Pretty much. The recommendation that comes out of all this research is remarkably simple and ultimately far more effective for most people.
Which is?
A straightforward buy and hold approach with a diversified portfolio. It's likely to perform at least as well as any technical strategy and very often much better, especially after costs.
And the financial benefits are real too, right? Lower fees.
Much lower fees, fewer commissions paid to brokers, and huge tax advantages because you're not constantly realizing capital gains. You let your investments grow long term.
It sounds almost too simple after discussing all those complex theories.
Sometimes the simplest approach is the best.
Okay, a final thought to leave us with.
Well, if trying to predict stocks from charts is basically like searching for meaningful patterns in random coin flips, what does that suggest about where your energy and focus should actually be directed if you're serious about building long-term wealth?
How could I have been so stupid as to trust the experts? That's quite a quote, isn't it? from JFK after the Bay of Pigs. In this video, we'll explore the key ideas from Chapter 7, really digging into this whole world of financial forecasting and, well, professional investing. It can be fascinating, but also, let's be honest, pretty frustrating sometimes. We're going to sort of trace the evolution of the securities analyst, from this image of a quiet numbers guy just recording data.
Right, the statistician in the back room.
Exactly. To this sharp-suited person visiting factories and then morphing into the modern star analyst flying first class, talking money, money, money.
Although you do hear those whispers, don't you? The cynical take that they're just high-priced courtesans tied to investment banking.
Right. That definitely hangs in the air.
And that really gets to the core question for us today, and for you listening. Are these fundamental analysts, these experts we're supposed to trust, are they actually useful? Does their work genuinely help you make better investment decisions?
Precisely. We're looking at a pretty major battle here. It's this ongoing war of words between, the confidence you hear from Wall Street pros and the skepticism, maybe even scoffing you often get from the academic side.
Yeah, it really pits that idea of deep fundamental analysis against something called the efficient market theory. And understanding this clash, who might have the stronger case? Well, it matters directly to your wallet. It affects how you should think about managing your own money.
Okay, so let's start right at the beginning. The analyst's core mission, predicting future earnings. I mean, everyone agrees on that, right? Earnings are key.
Absolutely. Earnings are the engine. They always have been, always will be, the core issue if you're playing the stock market.
And the traditional analyst approach, the logic goes something like this. You look at a company's track record, right? A proven history of earnings growth.
The idea being, if management had the Midas touch before...
Yeah, why would they suddenly lose it? It feels concrete,
Yeah.
based on actual corporate performance, not just squiggly lines on a chart like technical analysis.
And this is a big but. Academia throws cold water on that idea. A lot of research basically says knowing past earnings growth is, well, it's no help at all in predicting future growth.
No help at all, really.
Pretty much. You could have a perfect 10-year record and it tells you very little about year 11. There was this famous British study, colorfully titled Higgledy-Piggledy Growth.
Higgledy-piggledy.
Yeah, basically meaning haphazard, disorganized. And they found corporate growth was just all over the place, unpredictable. And American researchers found the exact same thing independently.
Huh. You think of companies that seem like exceptions, maybe IBM back in the day, they had that steady growth for a long time.
They did for a period.
Right.
But even IBM couldn't sustain it after the mid-'80s. And the list goes on. Polaroid, Kodak, remember Nortel Networks, Xerox.
Yeah, giants.
All saw their growth stories falter. The reality is that kind of continuous, predictable, long-term growth, it just doesn't really exist for most big companies. Even in the roaring 90s, only about 1 in 8 large companies managed it year after year.
By the early 2000s.
Forget it. None. It just doesn't happen reliably enough to base predictions on.
Okay, so if past growth isn't helpful, what about the analysts' actual forecasts based on their research, factory visits, all that stuff?
Well, some researchers, Craig and a colleague, actually got hold of real forecasts from Wall Street firms, 1-year and 5-year predictions for S&P 500 companies.
You compared them to what actually happened.
Exactly. And the results were, well, kind of startling. The analysts' forecasts, their carefully crafted estimates, were no more accurate than just sort of naively extending past trends, which we just said doesn't work.
Wow.
And get this, their 5-year estimates were actually less accurate than some really simple forecasting models, just basic extrapolation.
Okay, wait. So the 5-year forecasts weren't great? Analysts might argue, well, 5 years is too long. Dirt is on 1 year. What about those?
You'd think they'd be better, right?
Yeah.
Shorter term.
Yeah.
Even worse, their 1-year predictions were less accurate than their 5-year ones. It's bizarre.
How is that even possible?
It's hard to explain, and they tried arguing, oh, but stable industries like utilities must be easier. Wrong again. Predictions for utilities were just as inaccurate. No industry was easy.
So it wasn't just certain sectors being tricky.
No. And no single analyst consistently did better than others. Good performance was fleeting. It looked a lot like, well, like luck. Lady luck, as they say.
And there's other research confirming this.
Oh, yeah. Another study looked at forecasts for 1,000 big companies over 5 years. The average annual prediction error, a staggering 31.3%.
31%, that's huge.
It really is. As the author said, if financial forecasting looks like science, then maybe astrology starts looking respectable. But the serious point for you, the investor, is this: blindly relying on analyst forecasts when making investment choices. Well, you're likely setting yourself up for disappointment. Their main job, predicting earnings, is just incredibly difficult.
It is kind of shocking, though, isn't it, to think these highly trained, well-paid professionals might not be, well, great at their core task.
It seems counterintuitive, but it's not actually unique to finance. Think about medicine. Radiologists, even highly skilled ones, can miss signs of lung disease on x-rays maybe 30% of the time, even when the signs are there.
Really? Oh,
Yeah, or studies in psychiatric hospitals where professionals had trouble telling sane individuals from genuinely ill patients if they presented similar symptoms.
huh.
The takeaway isn't to bash professionals, but just to recognize that expertise isn't foolproof. We shouldn't take anyone's judgment for granted as being perfectly accurate.
That's a fair point.
Yeah.
So why is it so hard for analysts? You mentioned 5 main factors.
Right. Let's break them down. The first one is huge. The influence of just random events. Stuff happens that nobody can predict.
Like what kind of stuff?
Oh, all sorts. Unexpected rulings against utilities, sudden spikes in oil prices like in the 70s or early 2000s, big government decisions on budgets or laws, management shakeups, a new product flopping.
Or a drug trial failing.
Exactly. That biotech example is perfect. Celsion Corporation, 2013, promising liver cancer drug, fails its trials. Stock tanks, 90%. How do you forecast that? Plus oil spills, terrorist attacks, price wars, natural disasters. It's a constant stream of wild cards.
Okay, random events. That makes sense. What's number 2?
This one's about the data itself. Companies using, let's call them, opportunistic accounting methods, basically playing games with the numbers.
Ah, creative accounting. Like in the producers.
Kind of, yeah. There's that famous analogy, a company's income statement is like a bikini. What it reveals is suggestive.
But what it conceals is vital.
Right. Precisely. And companies have gotten very creative. Enron and Quest swapping fiber optic capacity at inflated prices just to book sales even though nobody needed it.
I remember that. What else?
Xerox booking future lease payments as current revenue. Sunbeam under Chainsaw Al selling BBQ grills in winter on delayed payments, pushing sales into 1 quarter before going bankrupt. Diamond Foods underreporting costs to hit targets and boost bonuses. Groupon having material weaknesses in its accounting.
It seems like there are endless ways to massage the numbers.
There are. Even using overfunded pension plans to boost reported earnings was common until market downturns exposed that trick.
And what about pro forma earnings? I hear that term a lot.
Ah, yes. Pro forma. That's a big one. Companies love reporting these instead of earnings calculated under standard accounting rules. GAAP.
Why? What's the difference?
The key thing about pro forma is there are no rules. Companies can basically exclude any costs they decide are special or non-recurring. Bad stuff, basically.
So they just ignore expenses they don't like.
Pretty much. It lets them inflate the earnings number they report, making it look much better than the reality according to standard accounting. It makes an analyst's job of predicting true future earnings incredibly difficult.
Wow, okay. So random events, dodgy accounting. What's the third factor?
This one's maybe a bit uncomfortable, but it's errors made by the analysts themselves. Sometimes they just aren't careful, or their judgment is off, or they make, frankly, serious mistakes.
You mentioned an anecdote.
Yeah, this story about Sloppy Louie, a metals analyst, misplaced a decimal point in a calculation about a copper company. A huge difference. When someone pointed it out, he apparently just shrugged it off, saying his report sounded more convincing with the error.
Or convincing. Seriously, that's worrying.
It is, and it's not just anecdotes. Dr. Lloyd Kreeser, a surgeon, looked at biotech analyst reports. He found forecasts where the market shares for competing drugs added up to way over 100%.
Like mathematically impossible market share.
Exactly. He concluded these analysts just didn't understand the industry they were covering. And look, sometimes analysts take shortcuts. Instead of deep original research,
They copy each other.
they might copy forecasts from other analysts or just accept the guidance the company itself puts out. It's easier, maybe safer, for their reputation. As Keynes said, it's better for reputation to fail conventionally than to succeed unconventionally.
Safety in numbers, even if the numbers are wrong.
Right. Now, not all analysts are just parrots, of course, but the average analyst's work can be, let's say, mediocre, sometimes sloppy, sometimes arrogant. They're only human, after all.
Okay, human error. Makes sense. What's number 4?
This one's a bit of a brain drain issue. The best, most skilled analysts often don't stay analysts for long. They move on,
Where did it go?
often into sales, chaperoning the general salespeople, spending time schmoozing big institutional clients instead of doing research, or, more likely, they move to the really high-paying jobs. Portfolio management, hedge funds.
Ah, managing the money directly.
Exactly. Think of Barton Biggs, legendary analyst at Morgan Stanley. He left to start his own hedge fund. It's seen as more exciting, more prestigious, and definitely pays better than just giving advice.
So the talent pool for pure analysis gets depleted.
It seems that way. There's this constant churn, with top talent moving up or out, which can impact the overall quality and consistency of the analysis available.
Okay, that makes sense too.
Yep.
And the fifth factor. You hinted this might be the biggest.
Yeah, this is the elephant in the room. The massive conflict of interest between the research side and the investment banking side of big Wall Street firms.
How did that work?
Well, years ago, brokerages made money mainly from commissions on trades, but competition drove commissions down. So the big money shifted to investment banking, underwriting new stock offerings, advising on mergers and acquisitions. That became the profit center.
The golden goose, you called it.
Right, and suddenly the analyst's job description implicitly changed. It wasn't just about accurate research anymore. It was also about helping the firm land and keep those lucrative investment banking clients.
So their bonuses depended partly on bringing in banking deals.
That's the allegation, and often the reality. Critics say analysts effectively became tools for the investment bankers. And this explains that historical, overwhelming bias towards buy recommendations.
Because you don't want to anger a potential client by slapping a sell rating on their stock.
Exactly. There's that infamous story of the analyst fired for recommending selling Donald Trump's Taj Mahal casino bonds, which later defaulted spectacularly. Or another analyst forced out for recommending selling Enron before the collapse. Offending management was bad for business.
And during the internet bubble, this got really extreme, didn't it?
Oh, completely out of control. Buy-to-sell ratios hit like 100 to 1 at some firms, especially those heavily involved in tech IPOs. It became a running joke almost. Investors had to learn a new language.
Where buy meant hold.
And hold really meant sell this dog as fast as you can. Unfortunately, a lot of individual investors didn't get the memo and took the ratings at face value.
Was there proof this bias actually hurt investors?
Yes, pretty convincing evidence. Studies showed that stocks analysts strongly recommended actually tended to underperform the market. And guess what? The very few stocks they rated sell often outperformed.
Wow, so the sells were actually better buys.
In some cases, yes. And firms without big investment banking arms. Their recommendations were generally more accurate. It clearly pointed to contamination.
Which led to that big Elliott Spitzer investigation, right? The smoking gun.
That's right. Back in 2002, Spitzer's office uncovered internal emails from Merrill Lynch analysts. Publicly, they were pushing internet stocks with buy ratings.
And privately?
Privately, they were calling the same stocks junk, crap, even a piece of shit. It was damning. Merrill Lynch settled for $100 million, promised reforms like separating analyst pay from banking deals.
So did things actually get better after that? Are recommendations cleaner now?
Somewhat. You see more sell ratings than before. And new regulations came in Sarbanes-Oxley, trying to improve corporate governance after Enron and WorldCom. And also Regulation Fee Disclosure, or Reg FD. That was important. It requires companies to release important information to everyone at the same time, not just whisper it to favored analysts.
So less privileged access for analysts.
Exactly. Which, ironically, makes the market more efficient, but also makes the analyst's job harder. They lose that potential edge from getting info early.
But the conflict of interest hasn't entirely disappeared.
Doesn't seem like it. Look at the BP oil spill in 2010, Deepwater Horizon disaster. BP's stock is plummeting, massive cleanup costs looming.
And the analysts.
Almost universally rated BP a buy or hold. Not one major analyst said sell. Why? Likely fear of losing BP's future investment banking business. The stock kept falling, costing investors billions. The conflict, though maybe less blatant, still seems to be there.
Okay, so given all these challenges, random events, accounting games, errors, brain drain, conflicts, the big question remains, do analysts actually pick good stocks? Forget the forecasts for a second. How do their recommendations perform?
That's the bottom line, isn't it? And we have a pretty good way to test this, using publicly available data, mutual funds.
Because they're run by these Professional analysts and portfolio managers, supposedly the best and brightest.
Exactly. They represent the collective effort of these highly paid experts trying to beat the market. So how do they do?
Well, the overwhelming evidence from decades of studies is pretty underwhelming, actually.
Underwhelming is putting it mildly.
Consistently, the research shows that the average mutual fund's return is no better than just buying and holding a broad market index like the S&P 500.
Right.
Sometimes worse, especially after fees.
Right. Over the long haul, professionally managed funds, as a group, do not outperform randomly selected portfolios of similar risk. A fund might have a good year or even a few good years.
But it doesn't last.
No. There's almost no persistence in performance. A fund manager's track record, just like a company's past earnings growth, tells you very little about their future success. Picking funds based on past winners is usually a losing game. It's heavily influenced by luck, by chance.
We've seen this cycle repeat, haven't we? The go-go funds of the late 60s. Those young gunslingers were heroes until the bear market hit.
And many crashed and burned. The Mates Fund lost something like 93%. Most of those stars vanished.
Then the top funds of the 70s often became the dogs of the 80s. Peter Lynch's Magellan Fund was a rare exception, but even he retired relatively young. The 80s stars faded in the 90s.
And then the 2000s, the lost decade. Remember all those genius fund managers from the late 90s, the ones loaded up with .com stocks?
Yeah, they looked brilliant riding the bubble up.
Until it burst. Then they massively underperformed. Investors learned the hard way that a 100% gain followed by a 50% loss just puts you right back where you started, minus the fees and taxes.
It's like that coin tossing analogy, isn't it?
Exactly. If you have 1,000 people flipping coins, by pure chance, someone's going to flip heads 7, 8, maybe even 9 times in a row. You might hail them as a genius coin flipper.
But it's just probability.
Right. In a huge game like the stock market, with thousands of managers trying, probability alone guarantees some will have amazing short-term runs. It doesn't automatically mean they have sustainable skill.
Didn't the Wall Street Journal do that dart throwing contest? Pitting experts against darts thrown at the stock pages.
They did, for years. And often, the darts did just as well, sometimes even slightly better than the expert stock picks.
Which led that Forbes reporter to say, luck plus laziness can beat brains. Ouch again.
It's provocative, but the hard data backs it up. Look at the reports from Standard & Poor's. They track this every year, consistently, over 5, 10, 20-year periods. Something like 2/3 or more of actively managed funds fail to beat their benchmark index.
So the index isn't average performance. It's actually better than most professionals manage to achieve.
Precisely. Index performance isn't mediocre. It regularly surpasses what the typical active fund delivers, especially after costs.
And doesn't the data get skewed by something called survivorship bias?
Yes, that's another crucial point. Funds that do really poorly often get quietly merged into other funds or liquidated.
Yeah.
They disappear from the records.
So the reported average performance of the surviving funds looks better than the reality experienced by all investors who started out.
Exactly. It paints a rosier picture. Even accounting for that, studies looking back decades, say to 1970, find very, very few funds that actually manage to beat the market consistently by any significant margin, like 2 percentage points, over the long run.
So the takeaway for you, the listener, seems pretty stark.
It really is. You are very unlikely to consistently beat the market by picking stocks or actively managed funds. Trying to find that winning manager or fund is like searching for that needle in a haystack.
So the alternative is
To buy the whole haystack. Invest in a low-cost index fund that simply aims to match the market by holding all the stocks in a broad index like the S&P 500. It's become an increasingly popular strategy for good reason.
And this isn't just about mutual funds, right? This applies across the board.
Yes, studies have looked at all sorts of professional investors, pension funds, insurance companies, university endowments, foundations. The story is broadly the same. As a group, professionally managed money does not consistently outperform relevant market benchmarks. There's just no reliable scientific evidence for it.
Okay, so this leads us directly to the academic's main counterargument, doesn't it? The efficient market hypothesis.
Exactly. If neither technical analysis, chart patterns, nor fundamental analysis, earnings forecasts, company visits, reliably helps investors beat the market, then academic theory offers an explanation. The market itself is efficient.
Right, EMH. There are different versions, aren't there?
There are. The semi-strong form is probably the most relevant here. It says that all publicly available information, earnings reports, News, economic data, everything in analyst studies is already reflected in a stock's current price.
Meaning you can't profit from analyzing it because the market already knows it.
Precisely. The price adjusts almost instantly. Then there's the strong form, which goes even further and says even inside information can't help you consistently beat the market because it's somehow also already in the price.
That one seems harder to swallow. Didn't people like Rothschild make fortunes on early information?
Historically, yes, the strong form is probably an overstatement. Getting the news of Wellington's victory at Waterloo early certainly helped Nathan Rothschild, but
But today,
today, with instant global communication, the internet, Reg FD requiring broad disclosure and strict insider trading laws, profiting from non-public information is much, much harder and riskier. The market is far more efficient at incorporating news quickly.
the Nobel laureate Paul Samuelson had a good way of putting it, didn't he?
He did. He said essentially, if you have lots of smart, well-informed investors constantly looking for bargains, buying undervalued stocks and selling overvalued ones.
Their actions automatically drive prices to reflect all the known information and future prospects.
Exactly. So for the average passive investor, Samuelson concluded, buying any one stock is basically no better or worse than buying any other. Random selection works just fine. Or, better yet, buy the whole market through an index fund.
So just to recap the EMH forms. Weak form says technical analysis is useless. Semi-strong and strong forms say fundamental analysis is also useless for beating the market because the information is already baked into the price.
That's the essence of it, and therefore an index fund should perform just as well as or better than most actively managed portfolios after costs.
It's important to clarify, though, E&H doesn't mean prices are always right in some absolute sense or that they don't bounce around. It means the market is so efficient at processing information.
That prices react so quickly that it's virtually impossible for any single investor to consistently profit from that information after it becomes known. The arrival of the information itself might be random, but the market's reaction is swift and efficient.
And interestingly, even some investing legends, people you'd think would champion active stock picking, have kind of come around to this view, haven't they?
It's fascinating. Benjamin Graham himself, the father of fundamental analysis, admitted late in his life that the strategies he pioneered might not work as well anymore because so many people were doing them. Peter Lynch, after his stellar run at Magellan, conceded most investors would be better off in index funds.
And Warren Buffett.
Even Buffett has frequently recommended low-cost index funds for the vast majority of investors, including in his own will for his wife's inheritance. It's quite an endorsement.
Okay, now shifting gears slightly, but related to market efficiency. Let's talk about high-frequency trading, HFT. That book, Flash Boys, really stirred things up.
It certainly did. HFT involves using incredibly fast computers, often located right next to the stock exchange's own servers, to trade stocks in microseconds, fractions of a second.
Sounds potentially scary or unfair.
The book highlighted potential abuses, but HFT actually provides some significant benefits to the market overall. It's really an evolution of trading technology.
What kind of benefits?
Well, it generally improves trading efficiency. It narrows the gap between buying and selling prices, the spread, which lowers transaction costs for everyone. It adds liquidity, meaning it's easier to buy or sell shares quickly without moving the price much.
Okay.
It also helps ensure that new market-moving information gets reflected in prices even faster. And it plays a key role in keeping exchange trade funds, ETFs, priced correctly relative to their underlying assets through arbitrage.
So you're saying HFT actually makes the market more efficient, benefiting typical investors?
In many ways, yes. However,
There's always a however. The criticism about front-running.
that's the main concern. The idea that HFT firms, with their speed advantage, can detect large incoming orders from slower investors, quickly trade just ahead of them, and profit from the tiny price impact caused by the large order.
Which sounds a lot like a form of insider trading, using speed instead of secret information.
It does have that flavor, and it's definitely something regulators like the SEC need to scrutinize and address if it's happening systematically. Abuses need to be curbed.
So, the final verdict on HFT.
It's nuanced. While specific predatory practices need policing, HFT on the whole likely benefits individual investors by contributing to tighter spreads, greater liquidity, and faster price discovery. It actually reinforces the case for index investing because it makes the market even harder to beat through timing or information advantages.
Right, it makes the efficient market even more, well, efficient.
Exactly.
So we've covered a lot of ground today. We went from that old image of the quiet analyst to the modern star. We dug into why forecasting is so incredibly hard.
All those random events, accounting tricks, human errors.
Right. We looked at the pretty sobering evidence on how professional money managers actually perform against the market.
Or rather, how they generally don't perform better.
And finally, we explored the efficient market theory and even touched on high-frequency trading, tying it all together.
Yeah, the key takeaways are pretty clear, I think. Analysts face huge hurdles, random chance, companies playing games with numbers, their own fallibility, the best people leaving, and these persistent conflicts of interest. And the historical record is just overwhelming. Active managers, as a group, very rarely beat a simple market index consistently over time.
So thinking about all of this, the final thought for you listening is, given how incredibly difficult it is for these full-time, highly paid, specialized financial experts to consistently beat the market, what does that suggest about the best way for you to approach your own investments?
Does it maybe shift your focus away from chasing hot tips or star managers?
Towards perhaps a more fundamental long-term strategy, like broad market exposure through something simple and low cost, like an index fund. And maybe stepping back even further, what does this tell us about how much faith we should place in expert predictions in other complex fields, where similar human factors and sheer randomness might also be applied? Something to think about. And hey, if you found this discussion useful, maybe learned something new, definitely hit that subscribe button. We do these deep dives regularly, exploring valuable ideas.
We appreciate you tuning in.
Yeah, thanks for joining us.